What advice, I mean, as a real estate investor, what advice would you give to someone who recently bought a home? They're at their maximum amortization, which is, I don't know, whatever it is, 35 or 30 years or whatever it is. And they're experiencing a hard time paying their monthly mortgage.
But one of the things I always say to people, when you get a mortgage, always try to get a HELOC attached to it. So when you have a HELOC, the home equity line of credit, what that does, as you pay down the equity, that equity goes over to, so normally you have to have at least 20% equity with a bank, right? But the extra payments that you make that increase your equity, so your mortgage pay down goes down, it goes over on the HELOC here, right? And the HELOC will, the interest rate on HELOC is so much better than like your credit cards, because credit cards, your interest rate, you're looking at 15, 20, and 15, 20 if your credit is good, because lots of time they're up to 30%, right? And so when you have a HELOC, as you pay your mortgage, it comes down, right? The beauty of having a HELOC as well is that you can actually use it to make mortgage prepayment to reduce your mortgage, right? And when you do that, right away, when you make a prepayment, it reduces your outstanding balance immediately, right? And so your amortization period is decreasing along with the interest that you're going to pay over time. So you end up saving a lot of money that way, right? And again, if you have credit, because a lot of times people have credit card debt, which is they're servicing those debt as well, right? The key is always try to keep your consumer debt low, right? And then that way you're not coming out of pocket to service debt unnecessarily. And those are, I call those bad debts, right? Mortgage debt, that's good debt, right? Credit card debt, bad debt. So try to move away from there. So even if you can get it in the interim, a regular line of credit, that will be good as well, because a regular line of credit, right? If you have a decent credit, you can get 8%, right? 6%, 8%, which is still better than credit card. So if you take that credit card debt and put it over on a regular, even if it's not a home equity line of credit, regular line of credits are really easy, really cheaper, because it's simple interest, right? Compared to compound interest from a credit card. So you can save some money there from debt servicing by just having a regular line of credit.